You guys are the kind of the behemoth on the block, behemoth on the street. Let's start off with this idea about asset allocation, because obviously there's been a lot of rotation amongst equity sectors. A lot of folks have gravitated towards bonds. When you're taking a more of a passive approach, indexing, things like that, can you still do those rotations, or is it better just to kind of just stay where you are and just sort of wait for whatever turmoil to sort of play itself out?
Yeah, I mean, what we're seeing, and we've been studying the cash flow behavior, as you mentioned in the opening, for several years. And we're in a very unique spot here because traditionally we saw flows being momentum-based. So think high equity returns, high cash flow to equity, low equity returns, low equity returns. But we're in this giant bull market for stocks, but cash flow is actually contrarian. So that would say that a lot of investors are actually rebalancing their portfolio, sticking to their policy portfolio, which is great news for their outcomes.
So, I mean, I remember earlier this year, everyone was saying the 60-40 portfolio was dead. I mean, they were basically having all these eulogies for it. It's kind of back, right? I mean, it never really went away.
Yeah, I don't think it ever went away. I mean, we've been tracking a 60-40 portfolio, and we have to put context around that. Just because you're 60-40 doesn't mean you're good or bad. It's a 60-40 diversified portfolio, low cost, has been very competitive versus the most competitive programs that are out there.
Fran, Guy in London, more and more money's flowing into private markets. Do you see a limit to that?
Definitely. When we see the flows going into non-liquid private markets, you clearly see that as a trend that's coming. I think when you have high valuations in the public space and also low yields, the search for higher returns is clearly going to some of the alternatives, including the private markets, as you mentioned.